Good morning, everyone, and welcome to the Saffery not-for-profit webinar. I'm Wendy Andrews, a VAT director in the London office, and I'm joined by my colleague David Humphreys, who's a corporate tax director, also based in London. And today we're going to look at two quite specific issues for not-for-profits around tax, and that's fundraising, both by sponsorship and by holding various different kinds of fundraising events. So we'll go through some of those events and talk about the relative VAT and direct tax issues to be aware of. But first, we'll start with some housekeeping. So just to let you know, if you weren't already aware, the webinar is being recorded, but as attendees, you can't be seen or heard, and your names won't be used as part of the session. If you would like to ask a question as we go through, that would be very welcome. You can use the Q&A button at the bottom of the screen, and then we'll be able to pick the questions up and answer them, possibly as we go along, or alternatively, we'll pick them up at the end. Following the webinar, you'll all receive an email with a link to the recording and also a short survey, which it would be brilliant if you could do just to help us understand what works best for you. Thanks very much. Okay, so a little bit of background as an introduction to why we thought we'd cover these two topics today. As I'm sure everyone's aware, there have been a number of challenges in the economy over the last few years with COVID, still very much there, although gradually, I think, fading into the background, leading to disruption of services, loss of income, increased demand, other things around inflation, energy costs, etc., have all led to a requirement not only for charities, for everyone, but especially for charities and not-for-profits to need to increase the funding to meet the increased costs, and to look at introducing new or additional funding or activities. So we're going to look at, and obviously in doing that, very important to be aware of the tax implications to make sure it's being done as efficiently as possible from a tax perspective, and that you don't get caught out by any unexpected tax consequences of whatever it is that you decide to do. We're going to look at two areas today, because both of them do have complexities around both direct and indirect tax. First of all, either holding internal fundraising events or taking part in third-party organised fundraising events. Very, very popular ways for charities to raise funds, but as I say, some complexities around tax. And secondly, increasing sort of corporate relationships with businesses locally or nationally, and working with them to increase funding. And again, there are a number of ways in which that can be done and a number of VAT and corporate tax implications. So we're going to talk through some of the specifics of both of those. And as I say, as we go through, if you do have any questions, if you just pop them in the Q&A, and then we'll be able to pick them up. Okay, to start off with VAT then, always sensible when talking about VAT just to set out the basics so that everyone kind of understands what the words mean, and what we're talking about as we talk about VAT implications. As I'm sure you're all aware, VAT is a consumer tax, which is paid by consumers at the end of the day on business transactions involving the supply of goods or services for a consideration. And the thing about VAT is it's a tax which goes all the way down the supply chain with people charging and claiming and charging and claiming. But once you get to the consumer level, or in some cases to the charity level, the VAT can't be reclaimed anymore. So it becomes a cost. And so when you're looking at VAT treatment of transactions, it's important to understand whether they're inside the scope of VAT or not. And that's a very big issue for charities because unlike a lot of other organisations, they're on the edge of things being inside the scope of VAT or not. So if you do make a supply which is inside the scope of VAT, which is subject to VAT, it's known as a taxable supply. If you make taxable supplies, the good news is that you get VAT recovery on the related costs, but the less good news is that you might need to account for VAT on the income you receive. So if your supply is standard rated, you'll need to account for VAT at 20%. If it's reduced rated, you'll have to account for VAT at 5%. But the best news is if it's zero rated, because you don't have to account for any VAT on the income, but you still have that recovery on the costs. Second category of sort of business activity is what's known as an exempt supply. That's where you're doing something in the course of business, but you don't charge VAT and you don't get VAT recovery on associated costs. And we'll be identifying some exempt supplies that might be made by charities as we look at fundraising events in particular. And then the last small area for corporate businesses, but big area for charities is non-business activity. And that's where you receive income which isn't in return for any goods or services that you're supplying. It's where you receive grant income, donations, or legacies. Again, you don't need to charge any VAT on those, but there can be a restriction on the related VAT recovery. And again, we'll pick up some of those as we go through. And the big VAT issue, as I'm sure you're all aware for charities, is that you'll have probably a mixture of all the above things going on. So working out when to charge VAT and working out what VAT you can claim back can get quite complicated. As I say, we'll try and talk about that in a bit more detail as we go through. Over to David now.
Hi,
For
everybody.
direct.
Hi. So I've been looking about corporation tax and direct tax generally, and so just as VAT doesn't really fit comfortably with charities, neither does direct tax. Although there are some important exemptions from tax available, which are mentioned later on. You would think that as a charity, you'd be exempt from tax generally because you're not in the business of making money and you're trying to do good. But that doesn't always mean that your activities won't be subject to direct tax in one way or another. And I've just got a very quick example there of a sort of gifts, for example. And you would think, well, in principle, a gift to a charity can't possibly be subject to tax because there's not a profit. It's not something you derive from carrying out an activity for purposes of making money. But there's a little quote there from the Corporation Tax Act that's actually saying that if a charitable company receives a gift from an individual that qualifies for gift aid, that's actually treated as being subject to corporation tax in the hands of the charity. But legislation then goes on to say that it's not actually taken to account in calculating total profits for tax purposes, provided the income, the gifts are applied for charitable purposes only. So this is an example of the sort of convoluted way in which legislation applies to charities, because if we look at the direct tax basics on the next slide, there isn't an overriding exemption from direct tax just because an entity is a charity. So if you're a charitable company, you'll be subject to, and you have taxable profits, you'll be subject to corporation tax, the main rate of which is 25%. If you're a charitable trust, you'll be subject to income tax at the basic rate of 20%. Unlike VAT, direct tax is a tax applied to profits. It isn't a tax on transactions or turnover. So when you come to look at whether or not tax applies, you would need to work out what your profit is rather than just your income, your gross turnover. So you'd be looking at what your income is, what your related expenses are to arrive at a profit, and then you decide whether or not that profit will be subject to tax because it doesn't fall within one of the charitable tax exemptions. There are various exemptions, income from property, investment income, lottery income, fundraising income, which we talk about in a bit more detail later, primary purpose trading income, which is probably one of the two most important exemptions available. But you need to make sure that you're falling within one of those tax exemptions in order not to be subject to direct tax, whether it's corporation tax for charitable companies or income tax for charitable trusts. So typically, if a charity is going to be carrying out a commercial activity or an activity for the sole purpose of raising funds, and that activity doesn't fall within, for example, the fundraising exemption, the charity would often look to carry out that activity through a trading subsidiary, which will then carry out any non-primary purpose trading activities or any other commercial activities that aren't covered by an exemption. But charity might also use a trading subsidiary because, strictly under charity law, charities aren't really permitted to trade other than as part of their primary purpose trade, because they're not really allowed to put the charity's assets at risk. So you might find that a charity will use a trading subsidiary for mitigation of risk and to ring fence activities, commercial activities, from the charity's main purpose, as well as to mitigate any tax liabilities. And there are 6 trading income exemptions. So these are activities that a charity could carry out itself without incurring a direct tax liability. And most important one probably is the trade that's the primary purpose of the charity. So, for example, you're a theatre charity and you're running a theatre, or you're a school and you're running a school. The whole concept of trade in this context is probably quite strange, really, to apply it to a charity, because arguably, you can probably see in some ways how a theatre charity is sort of carrying on the trade, because we've got an obvious comparison with commercial theatres, but it's probably a bit more difficult to sort of think of certain types of charities as carrying on the trade when they are sort of, maybe a hospice, for example. You wouldn't think that's carrying on the trade, that's providing a service. But nonetheless, it's a trading activity that has to be carried on as the primary purpose of the charity in order to fall within that primary purpose trading exemption. Um, Another exemption is a trade that's carried out by the beneficiaries of the charity. So, if, for example, people with particular different abilities, for example, are sort of running a shop or a farm or something like that. If they're beneficial to the charity and they are directly benefiting from the trade and carrying out that trade, then that also is a trading exemption. Lotteries, fundraising events, which we'll be covering in more detail later on, a small trade, which we'll also refer to later, and agricultural shows, which we won't be talking about in much detail today.
Okay, just coming back to VAT then, and to just sort of summarise the wide range of income typically received by a charity, and how that's treated across the whole kind of range of possible VAT treatments. So first of all, things that are standard rated for VAT, sponsorship income, we'll be talking about that and how to define it a bit more later on. Any license fees or fees for people to use your logo, again, that's potentially a taxable supply at 20%. If you sell registration fees for third-party events such as the London Marathon, that's a taxable supply. If you supply your staff to other organisations and make a charge for it, again, subject to VAT at 20%, and the sale of merchandise that you've bought in and that you resell, again, taxable. The zero rate of VAT, the main benefit of zero rating for charities is the zero rate for the sale of donated goods, and that's the zero rate that applies across all charity shops, where they can be if goods are donated to the shop, they can then be sold at the zero rate of VAT, which is obviously beneficial. A couple of other zero rates might come into play for the sale of children's clothes, and that's any children's clothes, and for the sale of all books and magazines. Exempt supplies, obviously a slightly tricky area, because if you make exempt supplies, you do get a restriction on VAT recovery. So raffle and lottery ticket income is exempt for VAT. If, as a charity, you get involved in making supplies of health and welfare services and you make a charge for those, then that income that you receive if you make a charge will be exempt for VAT. And the final exemption, which I'll talk about a bit more later, is the admission to fundraising events, which are actually held by the charity. So that's the whole range of sort of business income that a charity will receive, and it's likely VAT treatment. And then most of the other income that comes in from donations, from grants, from legacies, will be non-business income, so not subject to VAT and potentially with a restriction on VAT recovery.
Yes, looking at the sort of corresponding direct tax, corporation tax, or income tax treatment of that sort of income. Again, we've got some potentially subject to tax and some not subject to tax. Um, for direct tax purposes, when I talk about taxable, that's generally a bad thing because that's not going to fall within an exemption and potentially incurs a tax liability for the charity. Whereas for Wendy, taxable can sometimes be quite good because that means it's subject to VAT, but with a right to recover VAT. So you can sort of see just by that simple example how the CT and VAT treatment of charities isn't really aligned at all. They're quite distinct taxes, and there's no sort of very little joined upness between them. But so here, for example, profits or incomes not subject to tax would be anything within one of those tax exemptions for charities, so primary purpose trading, but also the sale or auction of donated goods, raffle and lottery tickets, for example, rental income, sponsorship where nothing is being provided in return, legacies, donations, and gifts. But then items that would be subject to tax would include non-primary purpose trading, um, income you receive for and allowing other people to use your logo, merchandise sales, um, services that you provide with letting. So, whilst income from property generally is exempt from direct tax, if you're providing services as well as just the general right to occupy a property, those services are not always within that property exemption. And indeed, depending on the level of services you provide, it could make the entire income source from the rental property to be subject to tax. And sponsorship, for example, might also be subject to tax if goods or services are being provided in return. So today's focus, we're looking at 2 points really: fundraising events and corporate income, primarily from sponsorship, both being activities the charity might carry on in order to boost its incoming resources. So fundraising events, it could be a third party event that the charity participates in, or it could be an internally event which is organised by the charity itself. It can be any sort of fundraising event, a dinner, a ball, a disco performance, festival and exhibition, etc. Um, and the income can qualify for exemption, meaning that no VAT on the income, but equally there's no VAT right to recover VAT on related expenses. This is possibly one of the most valuable VAT and corporation tax reliefs from which charities can benefit, but charities often get caught out when they try to take advantage of them because their failure to meet the conditions which are attached to the exemption. Interestingly, the exemption is actually primarily a VAT exemption, but where it applies, it also exempts from direct tax the income from the fundraising event. So this is a rare example of how actually it's the VAT treatment and the VAT exemption that determines the direct tax treatment and the direct tax exemption as well. The next point we're looking at is corporate income. So that would be where the charity is sort of engaging with a business, a corporate business, for in order to secure some funding. These sort of funding agreements you might enter into with a corporate can vary significantly, and how the agreement is worded, what it covers, the contractual arrangements between the charity and the corporate will directly affect the VAT and also the corporation tax treatment. What's most important in a lot of these corporate sponsorship agreements or agreements of corporate income generally is that they will refer to a donation from the corporate and possibly some sponsorship by the corporate as well. And there may also be the provision of some service, typically to the corporate, which might be the ability for the corporate to make use of the charity's logo or other IP. And it's quite important to look closely at the agreement to see how those they are dealt with, because that can have different VAT and corporation tax implications depending on what the income actually relates to. And very often we need to look at to making sure that the agreement does draw a clear line between the donation and the sponsorship element to ensure that in worst case scenario, not all of it, the donation element, for example, suddenly is seen to be a payment for a service and therefore subject to VAT.
Okay, all right, back to fundraising events then, and a bit more detail about them from a VAT perspective. Although, as David said, when we're talking about the conditions for VAT exemption, for once they are actually identical to the conditions for corporation tax, corporate tax exemption. So that's one of the few times when things sort of directly read across in that way. So first of all, an event is when we say fundraising event, it is a fairly broad definition of something that's happening, basically, that probably people are paying to attend in some way. Technically, it's possible for that to be an online event, though I was trying to think of an example of an online event that would be fundraising, and I think that's quite difficult to think of one, but potentially could qualify. Typically, it'll be things like a gala dinner, a quiz night, garden party, film showing, where generally it will be publicised as an event which is being held in order to raise funds, and people will pay to attend it in order to contribute to the funds of the charity. Um, there are, as David mentioned, some conditions. One is that you can only have a maximum of 15 of the same type of event in the same location. So, for example, if there was some sort of weekly event that happened, even though it raised funds, it wouldn't be eligible for the fundraising exemption. That condition very rarely bites, actually, because typically if someone's having lots of events, they'll be having them in several different places. You can ignore, when you're looking at the 15, small scale events that earn less than £1,000 a week. And once the fundraising exemption applies, you broadly get VAT exemption on all the income which is generated. And we'll talk a bit more in detail in a second about the types of income that will include. For VAT, it applies to charities and not-for-profits and their wholly owned trading subsidiaries. So the activity for VAT doesn't have to go through the charity in order to qualify for the fundraising exemption. And as we said, if the income is VAT exempt in the charity, then the direct tax exemption also applies to income in the charity, but just a slight exclusion there. It wouldn't apply if the event was held in the subsidiary. As I said, it's a fairly broad exemption from VAT, but as ever, there are some exceptions to keep everyone on their toes. Generally, the exception is perhaps where it's more beneficial not to have exemption. If pure donations, coin in a bucket type things are collected at the event, then that's still treated as non-business income to the charity. If there's zero rated income, zero rating in VAT legislation, zero rating takes sort of precedence over exemption if both can apply, because zero rated income is preferable because it gets you some VAT recovery on the related costs. So at a fundraising event, you might sell books, you might sell programs, you might sell children's clothing, you might sell, t-shirts or whatever. And also, if you have an auction as part of your fundraising event, and at that auction you sell some goods that have been donated, that will come within the zero rate that applies to charity shops for the sale of donated goods. But then the shutters kind of come down once the event's finished. And if you carry on selling merchandise or commemorative items rather, after the event, for example, a DVD of the concert, etc., then if it's sold after the event's finished, it won't be covered by the exemption and the usual VAT treatment will apply. So it is quite important, if you've got a fundraising event, to be able to keep track of the different income streams that are generated so that you can give them their correct VAT treatment.
And looking at the direct tax perspective, so the profits where the fundraising exemption applies, the profits won't be subject to tax so far as they arise from a VAT exempt event. And the types of income that would be covered there are similar to ones that Wendy mentioned earlier, but also including admission charges, sales of refreshments at the event, the sale of programs, advertising space, raffle tickets. Importantly, as Wendy mentioned, the exemption for direct tax only applies if the event's carried out by the charity. It doesn't apply if the event is carried out by the subsidiary. Um, Even though the VAT exemption applies for charity and charity subsidiary events, the direct tax exemption only applies if the event's carried out by the charity. So not quite usefully, the exemption is an example where VAT and corporate tax sort of are aligned for charities, but then suddenly you have this sort of misalignment, if you like, when you have subsidiaries involved. When you're looking at the exemption for the fundraising events, any ancillary source of income must properly form part of the event rather than a separate profit-making activity. So you can't really stretch the exemption to sort of try and cover other income sources which aren't directly related to the fundraising event itself. So it is quite a tight exemption. It's not flexible in that way.
So
Yeah,
we've attempted to summarise there the various income streams that might arise from a fundraising event, along with notes about the VAT liability and the corporation tax treatment. So for VAT, I think I've covered probably most of it, but just to draw your attention to the complexities around auction income potentially, because there are probably three different things you could sell in an auction: donated goods, bought in goods, and donated services. Donated services, for example, would be if someone had offered a free, I don't know, a spa day or some concert tickets or something that weren't costing anything. Important to remember that the zero rate for sale of donated items only applies to goods. So if you sell some donated goods, if someone's given, I don't know, what would it be, a set of golf clubs or something to be auctioned, that would be a zero rated supply. But if they'd given a free round of golf, that would be a supply of services. It wouldn't be eligible for the zero rate, and that supply would be exempt for VAT. And the same as similarly, if you'd bought in goods of some kind to auction, the proceeds from that would be exempt for VAT. And then just highlighting I mean, some of the less obvious things. For example, if the way you organise the event means that you get some commission from the bar sales, that's also exempt for VAT, maybe not obvious. And as I said, things that are sold after the event, like DVDs, not inside the exemption. So I think that probably illustrates from a VAT perspective how important it is to make sure you're still identifying the separate income streams from the event so you can give them their different VAT treatment. David, did you want to comment on the
yeah,
rather more straightforward looking
yeah,
corporation
yeah,
tax treatment?
yeah, yeah. My corporation tax is generally a bit more straightforward because if it's an exempt charity fundraising event, then the income at the event will be exempt from corporate tax or income tax of your charitable trust. The exception I have there is the sale of commemorative items after the event. So, as I mentioned earlier, this exemption really quite narrowly applies to the fundraising event itself, not sort of income received after the event. So that would potentially be subject to corporation tax, those sales of or income received after the event.
Can I just pick up while we're here, there's a question someone's asked, which is probably quite interesting and probably best to pick it up at this point. The question is, what if we work with an events company to organise our event and they sell the tickets, pay all the suppliers, and give us a share of proceeds? Could the event still qualify as a tax exempt fundraising event? Could they recover VAT on the event costs? And now that's an interesting one, which I've looked at kind of several times for charities. And really, it's all about the detail of how that arrangement works. If it's the case that the third party is organising the event, and then just making a donation of the profit or paying the profit under a contract, then it probably isn't inside the fundraising exemption because it's probably that organisation's event rather than the charity's. But if it's structured such that it's the charity's event and the third party is just organising the ticket sales, for example, though the ticket sales still make it clear that it's the charity's event, then it probably will still be within the fundraising exemption. But you'd have to look quite carefully at the detail of how that was organised. I don't know if you've had any comments on that, David.
Yeah. I just reiterate what you said about whose event is it, and and that would sort of determine whether the exemption would apply. Um, in my context, if you think about it, if it's an event carried out by the charity's subsidiary, it won't qualify for the direct tax exemption. So it is quite important that we do establish whose event it is as to whether or not it would qualify for the exemption. Yeah, so what happens if we have some income from the fundraising event that doesn't fall within the fundraising exemption? And if it doesn't fall within the charity's primary purpose trading exemption either, we might be having to look at the small trades exemption, which provides an exemption from direct tax on small trading activities carried out by the charity. And I have to say, it's very small. The exemption only applies where the turnover from exempt activities is lower of £80,000 or 25% of the charity's total income and resources. I think it's subject to an £8,000 de minimis amount that's allowed that's within the exemption for all charities. But it's the turnover that's important here, not the profit. So you're looking at is the turnover from £80,000. So in effect, the maximum saving, corporate direct tax saving you'd get from the small trades exemption is using the corporation tax rate of 25%, £20,000. But in practice, the actual benefit of the exemption will probably be lower because the profit that's covered by the exemption will obviously be net of expenses. So you're looking to exempt a profit on turnover of £80,000. So your profit will obviously not be £80,000, so it could be significantly less. If the £80,000 is breached, the exemption might still apply if there was a reasonable expectation at the start of the year that the exemption wouldn't be breached. It just so happened that your sales are slightly more better than you anticipated. But if it is breached and you didn't have that expectation that it wouldn't be, then the exemption is withdrawn in its entirety. It's not you get an exemption on the profit on the first £80,000 of turnover. If you go above the 80,000, even by only £1, you lose the exemption altogether. Looking again at what happens if there is an event that's not within the exemption. I mean, what would you do then? You could, for example, set a basic charge and invite those attending to supplement that charge with a voluntary donation. The minimum charge would be standard rate for VAT unless it's exempt under another provision. And for direct tax purposes, it would be regarded as taxable trading income. Additional contribution won't be subject to direct tax and outside the scope of VAT if basically it's a donation, it's voluntary, and that would require that all the following conditions are met, that it's clearly stated on the publicity material, that anyone paying only the minimum charge would be omitted without further payments, and also the additional payment doesn't secure any particular benefit, and the extent of the contributions ultimately left to the ticket holders to decide. I mean, we're probably familiar to this sort of concept when we're looking at gift aid and ticketed events, and where we sort of have a standard ticket price and a suggested donation. And it's a similar principle applies here. Um, Another couple of conditions that need to be met is that if you've got a kind of a performance, a sporting fixture, the minimum charge can't be less than the usual price for any particular seats at the event, at the commercial events of the same type. And for other kind of fundraising events, that the minimum charge can't be less than the cost incurred in arranging the event. But typically, I mean, if you are in doubt about events not being within the fundraising exemption for direct tax purposes, you might actually look to actually carry those out through a trading subsidiary, which we'll look at in a bit more detail later.
Okay, we're going to go on to talk now a little bit more, as we said earlier, about income that you might get from corporates. Before we go to talk about wider income you might get from corporates, just a reminder that one of the things that's included in the fundraising exemption is any sponsorship income which is received from a corporate organisation or any other from that matter, which relates specifically to the event. So if you're holding a golf day and you have a large corporate sponsor such that it becomes the, I don't know, Sainsbury's Golf Day, if their sponsorship has been specific to your exempt fundraising event, then the sponsorship income they pay you, rather than being standard rated, because they're clearly getting a lot in return in terms of promotion and exposure, etc. Usually that would be taxable, but if it relates specifically to a fundraising event, then it will be exempt for VAT. So going on now to look at wider sponsorship income that might be received. And the key issue when engaging with corporates to kind of work with them to increase your funding, your income. It can be done in one of two ways. Either they might be prepared to make a donation with sort of no strings attached, or it might be more beneficial from a fundraising income generating perspective that they should actually get something in return for the money that you're paying to them. So the general principle is that if someone is especially a business, I suppose, is making a payment to you, it will be outside the scope of VAT as a donation unless they're getting anything in return for it. And if they're getting very broad sponsorship, very broad naming rights, all over everything, then that probably will be a sponsorship agreement, and will be the income you receive will be subject to VAT. There are some exclusions for that. In the HMRC guidance, they say that the mere kind of acknowledgement of a donation, for example, at the back of a programme or in some other document that just has a list of sponsors, doesn't make it into a list of people who've donated, isn't sufficient to make the income into a donation. Interestingly, the HMRC guidance even says that naming a building isn't a significant enough benefit to make something subject to VAT, which I think is very strange. So I have talked to a number of charities when something like that's been happening. You have to look very carefully to make sure that there isn't an argument that there's a wider benefit there for the person, especially a corporate, making the payment. I think that final point there is that, do you want to cover that, David? I think that's
Yeah, I think it might be on
trading
the
income.
next slide where we're talking about
All right, okay.
yeah, so the income from corporates, what HMRC would regard as being a supply of value, if you like, to the corporate, and that might include, any large or prominent display of the sponsor's logo, or their corporate colours, or a description of the sponsor's products or services. As Wendy mentioned earlier on, if it's a charity exempt fundraising event, it doesn't matter how prominent that is, but if it's not a fundraising exempt event, you do need to think about what you are giving the corporate in terms of, are you making a supply to the corporate that would potentially be subject to direct tax. Other services that a charity might provide in return for sponsorship payments would, for example, include the use, well, probably less likely to include the use of the charity's mailing list these days because of GDPR, but potentially the use of the charity's logo or the endorsement by the charity of the sponsor's products or services, links to the sponsor's website from the charity's own website, or exclusive rights granted to the corporate to sell their goods or services on the charity's premises. So you sort of do need to look quite carefully at what the corporate sponsor is getting in return for their sponsorship. And this is an example where you need to look quite closely at what the agreement says the sponsor can have and how you divide what you charity receives from the sponsor in relation to payment in return for these services, as opposed to a pure donation, if you like, from the corporate to the charity. Very briefly, I just mentioned trading subsidiaries here. Typically, a charity will use a trading subsidiary where it's carrying out commercial, non-primary, non-direct tax exempt activities, with a view to making a profit and to then transfer that profit back to the charity. The trading subsidiary itself is subject to corporation tax in the same way as any other company, but typically it will donate its profits to its parent charity and claim a deduction for that donation in computing its taxable profits. And any company can make a donation to charity and claim a corporation tax deduction for that. So the deduction tax relief for donations isn't a special relief available to solely to subsidiaries owned by charities. The special rule that does apply to charity-owned subsidiaries is they have up to 9 months after the end of the accounting period to make the donation and then treat that donation as having been made in that accounting period for the purposes of offsetted against their taxable profits for that period. A few rules about what the donation has to be and how it can be made. The trading subsidiary must have sufficient distributable reserves to make the donation, because under company law, the donation is treated as a distribution by the subsidiary to its parent, i.e., a bit like and therefore it can only make that distribution to its parent if it has sufficient distributable reserves, i.e., retained profits, and it must be in cash, and it mustn't be a circular arrangement under which the donation from the subsidiary to the charity is followed by a loan back from the charity to the subsidiary. Or the charity might consider how it's going to be funded in its subsidiary and whether or not making a loan to the subsidiary is for the wider benefit of the charity. But usually you really should avoid the sort of circular arrangement where the cash just sort of goes up to the charity and back down to the sub.
Okay, I'm just going on with a few comments about sort of documents and agreements, particularly where we're talking about partnerships or relationships with corporate organisations. There will be an underlying agreement which is setting out the agreements between the parties. Very important that that's clear about what they, in particular, the VAT treatment of the various payments which are going to be made is clear in the agreement along with the VAT treatment, and that's particularly important if you have an agreement which perhaps covers both a donation and a supply of some kind of services which are subject to VAT. Really important, as we've said before, I think, that it's clear that those are two different things. How much is the donation and how much is the sponsorship or the payment for services? Because the risk is that if you don't correctly or clearly enough identify which is which, then HMRC might come along and say all the income received under that contract was subject to VAT as sponsorship because you didn't clearly enough define what amount was a donation. And also, it kind of follows on, but it's important if there are any deliverables under the agreement that you're providing to the corporate in return for the payment. Really important that those deliverables are not linked in any way with the donation element. They both really have to stand on their own. Probably, ideally, they'd be in separate agreements, but they are all in together. Really important to make sure they're set out carefully and separately. Just a few final points on sponsorship, most of which I think we've we've covered. It's just having that awareness, I think, which isn't always sort of blindingly obvious, but just the awareness that you might think you're receiving a donation, but actually looking quite closely at the detail of the agreement to see what's being whether you're supplying anything, and if so, what, to make sure that what you think is a donation doesn't veer into sponsorship. It is an area that HMRC do look at, I think, when they're looking at charities. So one to be aware of. And the final element of a sort of corporate agreement, there might be an agreement and it might be just for a donation, but you see quite often as part of that agreement, the entity which is making the payment to you might want to be able to use your logo in some way to promote the fact that they've made charitable donations, etc. And generally, as a result of that, the charity will have a requirement to specifically license the logo to the partner, and potentially to charge a license fee for that. Really important that if you have a contract and you're going to treat the income as a donation, that you recognise the fact that you're also making a supply to your sponsor of the right to use your logo, because that will be a separate taxable supply. And it's technically possible that if you don't refer to a separate charge for the logo, the whole of the donation could be subject to VAT, because HMRC could argue it was all payment for the use of the logo. So really important for that to be ring fenced. It used to be the case that it was considered reasonable for a very nominal payment to be made for the logo, such as £1. I think as various case law, etc., has developed on VAT, it's become much less acceptable to have £1. Even though it's a third party arm's length agreement, technically you could charge whatever you wanted. There is an argument, though, to make sure that it's quite clearly a separate business activity of generating the income, that you have a slightly more significant consideration than £1. Then it kind of links in with corporate tax, because if you're then receiving some trading income in the form of the sale of the use of the logo, then it might be more appropriate for that income to go into the trading company. So you might need the trading company also to be a party to the agreement. I think that's right, isn't it, David?
Yeah, we might need some kind of tripartite agreement between the charity, the subsidiary, and the corporate. So yeah, that's sort of
Great, thank you. Okay, so now we're leaving sponsorship behind and coming back to events, but this time talking about third-party events. So that's not the typical fundraising event that a charity arranges itself, but increasingly, I think we're seeing, probably as a result of widespread use of social media, etc., that charities will be linking in with big third-party events and encouraging their supporters to take part in those events as a sort of platform for fundraising for a specific charity. And you'll obviously see that if you see the London Marathon or the Great North or South Run, etc. Loads and loads of the runners, I think, will be taking part on behalf of a charity. So the important from a charity's perspective, to kind of understand how you're organising that participation in those third-party events, because they're not covered by the fundraising exemption, because they're not your event, you're not organising it. So you have to look quite carefully, certainly from a VAT perspective, at how you're organising that participation. Typically, you will charge a registration fee for the event to the participants, but you will also expect them to raise some money for you in addition to that registration fee. And what's really important is that you're able to distinguish between the two things, because the registration fee will be subject to VAT. You'll need to account for VAT on it, and you'll be able to recover VAT on the registration fee that you pay to the organiser of the event. But it's really important that that amount which is subject to VAT is very clearly ring fenced from any donations that are then raised by the participant for you. And the danger area there is where you might require a minimum donation, or where you might offer people incentives for raising money. If you say you can take part in the London Marathon for our charity, but you must raise £500, then there's a risk that HMRC could argue that that £500 was actually the registration fee. It wasn't a donation, because the person who paid it got the ability to take part in return for that payment. And then the other risky area is around incentives. If the HMRC guidance not amazingly clear in this area, they say that you can offer participants things like, I think it says, a T-shirt or some other low value gift in return for their fundraising. But if you get into the realms of giving people who raise over a certain amount of money mountain bikes and cameras, etc., then again, they're not making a donation, they're making a payment for you to you because they're getting something in return. And these arrangements can be quite complex in their structures. So really important to make sure you're looking at them from a VAT perspective, to make sure that you're getting a registration fee which is vatable, and then and then donations which aren't subject to VAT. And that then, as I say, feeds through to the VAT recovery on the related cost of the event. If the participant is paying a registration fee, that's subject to VAT, but it means you get VAT recovery on what you pay for the places. And it also means that because the whole event is generating some taxable income for you, it will get you some VAT recovery on the other costs of the event. Whereas if there isn't a registration fee paid by the participant, the whole thing, the whole amount of income will be fundraising. So all of that costs will again probably be partially recoverable. But as I say, quite important to look at the detail of how that sort of thing is being structured. And on to looking at some of the other kinds of events that charities might get involved in. And that's, I've just generically called it UK and overseas events. These are the more complex kind of expedition type, Kilimanjaro, Three Peaks, that kind of thing. Um, Probably falls outside the fundraising exemption again, A, because it's probably arranged by someone else, and B, because anything that involving overnight accommodation automatically falls outside the fundraising event, fundraising exemption rather. And again, these can be quite complex organisations. And from your perspective as charities looking at the correct VAT treatment, it's really important to establish what role you're playing. You might be going for it and arranging the whole expedition yourselves, in which case, if you're buying plane tickets and booking hotels, etc., as the principal in the arrangement, then you'll have quite a complex VAT situation involving the tour operator's margin scheme, which I'm not going to go into now. As is more likely if you act as an agent, effectively introducing your participants to the organizer of the event, then it's likely that the income you receive will from the organizer will be commission, and then you might receive separate fundraising income from the participants. Again, very important to make sure that's quite clearly distinguished.
Yeah, just finally, just a slight nuance on participatory events and gift aid. We're not really talking about gift aid today, but I just wanted to touch briefly on the where you do have these participatory events where people are required to raise a certain amount of sponsorship for you, for example. You need to be careful as to who's actually sponsoring the participant, because for gift aid purposes, you're looking at is there a benefit received by the donor or a person connected with the donor in consequence of the donation. And so if you're sort of saying to people, you can take part in this event, but you need to raise X amount of donations. If those donations are coming from people connected to the participant, and there's a list there of who is deemed to be connected to this purpose, then those donations would be regarded as actually, being part the benefit of being able to participate in the event would be treated as being a benefit derived from the connected with the donations from not just the individual who might pay for part of their make a donation themselves, but also for any donations they receive or sponsorship they receive from connected people. It's just something to watch out for on gift aid and participatory events. Yeah, so they're the sponsorship that they're receiving from their connected people would that contributes to the participants cost of the participants' involvement in the event would be deemed to be a benefit to the participant and indeed a benefit therefore to the people making those donations or those sponsorship payments because the part where the participant is connected to them.
Okay, great. We do. I'm just kind of looking through. We do have a number of questions and a few minutes left to cover them. So let me just quickly have a look. One question is providing free tickets to the sponsoring company a benefit? It's a good question, but probably if it relate, I was just thinking if it relates to a fundraising event, then and the income is treated as being exempt anyway. I think it's fine if there are free tickets because I think they'd be exempt as well anyway. I think that the issue only arises if you've got separate things. If you've got someone making a donation and getting free tickets, then you would need to recognise that there are two different things going on. But I think probably otherwise it's probably fine. But as ever, important to look at the detail. Someone's asking an easy question about the slide deck. Yeah, I think it will just be part of the recording. I think the recording will include the slides, so that's fine. How would you suggest working out a reasonable price for prominent displays of a corporate logo? I can't find any guidance on this! Exclamation mark. Yes, agreed. It is a bit of it's a vague area. Generally, it kind of depends what the agreement says. If the agreement is very clear that there are going to be very prominent displays, maybe there needs to be a higher price. Generally, though, it's quite a generic, just right to use the logo. So I don't know. I don't know, and it depends. Are the answers? I don't know if David's got any other.
Yeah, I suppose in part also you need to think about are there any costs that the charities will be incurring in making the display prominent. So I imagine that the price you charge the corporate for prominently displaying their logo must at least
That's a good point. Yeah, no, that's a
equal the
good point.
costs you might incur in displaying it. So you can't sort
Yeah,
of say it's £1, but it costs us £10,000 to put your banner
yeah, no,
front or whatever. So
that's a
you
good
do need to
point.
be mindful of what it's costing you, and the expectation that the charity is always going to be looking for some kind of return.
Yeah. Then there's one which is reading to me as slightly like an exam question. I'll read it out, and while I'm reading it, I'll see if I can think of what the answer is. Our charity is running a direct mail campaign later this year, which we would usually treat any donations in return as out of scope of VAT. Great. However, this mailing will contain raffle tickets with a contribution being received from a local company whose logo will be on the raffle tickets. This seems like sponsorship and potentially means we would need to charge VAT on the supply. But as it is a raffle, does the VAT exemption for raffles override the taxable supply treatment? That's a very good question. Said she, playing slightly for time. There's a lot of different things going on in there, I think. I think if you're identifying any income that relates to the sale of the raffle tickets to the donors, then that's going to be exempt because the sale of raffle tickets is exempt. But I think the income from the corporate sponsor doesn't relate directly to raffle tickets. It relates to sponsorship and is more likely to be VATable, would be my quick answer. But I would say that's a complicated area and needs to be looked at quite carefully. And the final question is for David. Can you remind us whether the trading sub has to formally document the decision to gift aid the year's profits before the end of the financial year?
I don't think it does for tax purposes. It just needs to make sure the donation is made within 9 months of the year end. For accounting purposes, it might be slightly different in that if you want to recognise that donation as in your accounts for that preceding period, you might need to have some kind of a formal agreement at the end of the year that actually commits the charity to making that donation.
Okay, and just a couple more. What if we have an existing brackets old agreement for a £1 deal, I assume for a logo? I think you probably do need to look at that. I think there is a bit of a VAT risk around that. So sensible to revisit those kind of agreements. Copy slides again. I'm not sure whether we send copy slides as well as the recording. I can check that and see if we can do that. If we pay the entry fee to a third party event for people fundraising for us, is there a liability? You have to be very careful about how that's presented to the participants. Because if it appears that any of what they're paying you is so that they can take part, then you will get a VAT liability. Technically, you would have to be able to let people take part without paying you anything in order to make sure that what people did pay you was a donation, if that makes sense. Yes, and another request for the slides separate from the recording, please, if possible. We will try our best to make sure we can do that. I don't see why we can't, so hopefully that'll be possible. So I think that's everything we had to say, and it's bang on 10 o'clock. So thanks very much indeed. Hope you've found it useful. As I say, you'll be getting the recording and hopefully a separate copy of the slides after the event. But really nice to see you and talk to you. Thanks very much. Thanks.